Right, so chaps, today I'm going to be breaking down exactly how I caught this 117R rascal trade on Euro USD. I'm going to be breaking down exactly what I did step by step in order for you guys to catch positions like this. If you want to see some of the free value, the free content that I have on the Discord, make sure you click the link down below. So without wasting too much more of your time, let's jump straight on the charts. As usual, we are going to be starting on the 4-hour time frame, right? Super crucial. 4-hour time frame and the 1-day time frame are the most important parts of your breakdown analysis. We need to be building a picture on what price is trying to do. So this morning we were selling down, right? So as we can see, price was retracing. One thing I like to do is take a step back and figure out what price was trying to do maybe a few days ago to then figure out whether we're still in that intention, right? So quick rapid fire, we can see price come up here with a lot of volume. We started stalling. What happens when it starts stalling? We need a liquidity sweep. Here's your first point of liquidity. Price comes down, it's taken that liquidity, price is bought up, and then price is retraced. So at this current stage, we were witnessing price come up and retrace. As we came back up on the lower time frame, which I'll break down in a second, we were looking for those sells again and then just targeting the previous external low, having a safe take profit. You know, I'm not going to try a target here or here. I like having a safe target level. So with that being said, we'll then jump down to the 1 hour, right? And I'm going to explain to you the real reason why I wanted to see price take that low. So if we have a look on the 1 hour, right, we've seen price push up. And then we have that retracement. And you're probably wondering why price didn't buy off of this to create new highs. And the real reason is because you need to understand mitigated zones and your first point of liquidity. So here we have the first point of liquidity. But then if you look to the left of that, we are actually inside of an order block. So that black candle there is an order block. If the first point of liquidity is inside of it, that means that this whole order block is already mitigated. So price isn't going to buy from this level again. So the first point of liquidity, instead of it being here, is now all of a sudden down here, because beneath this we have, you know, valid zones. We have, you know, obviously that point of liquidity that's not already been taken. So that's why my targets were there. I understood that price is not going to start buying again until we see that liquidity sweep. And the first point of liquidity sweep is going to have to be this low. It can't be this low because it's already inside of a mitigated order block. So price cannot buy above this level, right? So that is so important. That's one of the main things you guys really have to master. You have to understand that if price is trading and has already mitigated an order block, if it comes back up again, that's not your first point of liquidity. This is because you're inside of a previous order block that's already been mitigated by this high, right? So the first point of liquidity that is here, just because it's trading inside of a mitigated order block, we are now going to have to move that first point of liquidity to the next high. As long as this high doesn't mitigate anything to the left, we can then use that as our valid first point of liquidity. So that's why price will then come up, and then that's when you'd get your sells. So if we have a look now and jump down the time frames, we can see that at the time of London session, we were looking for a continuation. So the initiation to see price create this new low was here. As we can see, coming into the market, we've already seen these sells being initiated. So what we're doing is now looking for the continuation, which means we're looking for the additional sell positions between the high and the low. So we want to see some sells in here that's going to continue down to this low. So marking out all of this correctly, we can see that the first take profit is going to be the previous external low. This is the high, so we don't really want to see price push above this, otherwise we'll end up getting, you know, invalidating our positions. So if we are looking for continuations, what do we need, right? We still need the same formula, the same concept that higher time frame needed. We still need to see a liquidity sweep and a POI, right? So we've done the higher time frame trend analysis. Now we're looking for the lower time frame entry analysis. So as we were retracing here, we can see that price retraced up here, tapping into this POI, didn't create a new low. let's ask ourselves, why did price not create a new low? The reason it didn't create a new low is because beneath that order block, are we witnessing any liquidity sweep? No, we're not, which is why price failed to create a new low. So when this happens, price is then looking to seek genuine liquidity, which in this example, our first point of liquidity is here on the 15-minute. We can then go down to the 5-minute and potentially refine the liquidity, because we might have small little order blocks mitigating each other over here, which then would mean that our first point of liquidity is, needing to be adjusted. So one quick thing I'm going to show you as well, having this intention, trading this approach, you can counter trend positions. So even though we're waiting for the sells, we know that price cannot sell until it's come above this level. So what we can do is we can actually buy up to this level. I didn't see any buyers this morning, so I don't want to sit here and say that, I took buyers in an area where I actually was watching this live and didn't see it. It was quite choppy, so yeah, we're going to leave that alone. But if we just jump back to the 15-minute, we've identified where our first point of liquidity is. Now we need to identify where the first point of interest is. So the first order block, very easy to understand what an order block looks like. It's a very clean looking order block. So that's what we're going to be using, right? This is our first point of interest. So once we see price start coming up, we can see, look, jumping down the 5-minute, we don't need to refine liquidity because it's not, on the 5-minute, there's nothing gets mitigated. If we jump down to the 1-minute, there may potentially be some order blocks. So yeah, as we can see here, the top of this order block was inside of this order block. This order block is, hold on, how do I make this easy for you guys to see? So this order block here was traded in by here. This order block is trading within this order block. This order block is trading within this order block, and so on and so on. So this first point of liquidity now needs to be adjusted to the first point where it's not mitigating anything. As you can see above here, it's not tapping into any, range or anything, order block. So that is going to be your first point of liquidity. So all we were doing there is just refining that first point of liquidity, which saves you from potentially seeing price push just above this level and then potentially taking the sells. You now know how to refine liquidity correctly, so you're not going to be, making that silly mistake of entering slightly too early. So, as we can see, we've got our PLY, we've got the liquidity now. What we're going to be doing is entering off the first candle close with volume. The first candle to close with volume, in my opinion, is this candle here. As we can see, the previous black candle is not a very big candle. This one here was slightly bigger and we had hardly any wicks. The wick on either side is very equal, so we know that the selling power is still overruling the buying power. So this would be your entry. Or if you wanted to play a little bit safer and you wanted to wait for, or where else we could see potentially here. You've waited for the price to push down, we've retraced up, we're looking for a bit more of a premium price, then you've entered, and then we've got our take profit down here, which we marked out earlier. Drag that across. I don't know how this is lowered the risk to reward, but now this is only a 15R. Anyway, perfect trade. As you can see, we had some small drawdown, but with the correct use of order blocks on liquidity, we understand what highs should be protected and what lows should be protected. But as you can see, very nice volume coming down into the market, coming down towards the TP. We've hit it very quickly, and they're the trades that I like, which is why I don't like holding positions, because even if price were to come down even further and create a new external low down here, we've still escaped sitting in all of this retracements and consolidation. So that's why I like targeting either liquidity or an external high or low. So make sure you're focusing on those mitigated points of interest and those first points of liquidity, because that is genuinely hand on heart where you're going to see your trading career completely change. Literally, it's only been the past, I've been trading for 6 years. I've been trading for nearly 5 years profitably. And I've only been using liquidity inducement for maybe 2-3 years, and that's where I've seen my trading just completely elevate. My risk to reward is so much higher. My win rate is around the same, because you're being a bit more aggressive. You're taking more positions and you do take more losses, but because you're taking more positions than when I was being safer, it kind of balances it out. But yeah, you need to start trading this way. Make sure you're being aggressive and being risky, but you have to stick to a strict plan, right? If you're taking every position you see, that is good, but you have to be taking every position you see within a strict routine. Otherwise, you're going to be taking 12 positions a day, asking yourself why you've lost 10 of them, right? I take every position I see, but that might only be between 1 and 4 positions a week. So you've got to kind of see the difference and not be too gamble. And that's that. So hopefully you guys have taken something away from this video, and I'll hopefully see you in the next video.